Checking the movement in the bond market today. We've been talking about it all morning. Treasury yields are on the rise. You're taking a look at the 5, the 10, and the 30-year yields on your screen right there. The 10-year yield right around 4.71%, a move to the upside of just around 6 basis points. So that move coming and hitting at the highest level that we have seen in just about 5 months after that GDP print showed that first quarter showing that weaker growth and also sticky inflation, clearly a worrisome sign here for investors. Let's talk about that reaction with Althea Spinozzi as Saxobank head of fixed income strategy. Althea, it's great to have you here. So first, is your reaction to the jump that we're seeing in yields today?
Well, Seana, it's pretty simple. The bond market is sending the same message that has been sending in the past couple of weeks, which is if inflation is not going to drop sustainably towards the Federal Reserve target of 2% in inflation, there is no way that we are going to see a bond bull rally. You see, Seana, when we look at bonds, inflation is their main driver. If inflation remains sticky, or there is the risk that it might rebound because of several factors, including escalation of tensions in the Middle East, that's bearish for bonds. So when we look at the 10 years at 4.7% right now, what it's telling us is that investors are expecting real growth to remain at trend around 2% and inflation to remain sticky well above the 2% Federal Reserve inflation target.
Althea, do you think we could see the 10-year yield hit 5%? Do you think it's going to continue to trend to that upside given what you were just saying?
Absolutely. 5% is now a very high probability. There is also a very high probability that yields continue to rise towards 5.25%. However, to see a break above that level, we need to have a second wave of inflation. We need the Federal Reserve to talk about hikes again. And right now, that's a little bit of a tail scenario.
Althea, when it comes to investment opportunity or what investors should do at this juncture right now when it comes to the bond market, what are you advising clients to look at?
Well, Seana, I think that this is the moment to remain cautious, to try to limit credit risk and also duration risk. So we really like the front part of the yield curve. There is almost no way to lose money in the 2 years tenors. You see, if we assume a holding period of 1 year and yields rise from 5% to 11%, you will be still in the green. Yields need to rise well above 11% to lose money on that position. It's very different when we look at the longer part of the yield curve, especially the longer part of the yield curve, which is very dependent on bets on interest rate cuts. So it's a very much more directional kind of bet.
Althea, how closely are you tracking the geopolitical risk developments? Because at least when you take a look at the reaction that we see play out across the equity market, across the bond market, it almost seems like that worry is on the back burner for now. How big of a challenge or risk do you see the rise in geopolitical escalation here presenting potentially here for the bond market?
I think it's huge, Seana, because what we have learned since tensions escalated in the Middle East is that commodity prices remain very sensitive to what happens in terms of geopolitical equilibriums. We saw oil resuming its rise. We saw metals prices going up, and that is bullish for inflation. And it might cement a second wave of inflation, which is bearish for bonds. And that's why our message is to remain cautious. If you look at the bond market, remain in the front part of the yield curve up to 5 years. But maybe the 10 years can still offer some value in case of an edge against of a market crash because it offers a good risk-reward ratio. But beyond that tenor, it's important to remain cautious.
All right, Althea Spinozzi, we appreciate your insight today. Saxobank as head of fixed income strategy. Thanks so much for joining us here, Althea.
Thank you very much.